Welcome to No Stupid Questions with Susan Edmunds, the podcast that gets you answers to all the questions you've ever wanted to ask, as long as they relate to money. I'm Susan Edmunds, RNZ's money correspondent. Thanks so much for all the questions you've sent in so far to questions@rnz.co.nz. Please keep them coming. We want anything money related. I'm joined today by Justin Gregory.
Glad to be here.
It's a busy week for money news with the Reserve Bank doing its thing and the government making changes for job seekers.
And our first question this week comes from Rosie, who wants to know why we talk about pay rises in percentage terms. She says, using percentages mathematically increases income inequality, doesn't it? By basing it on the percentage, low-income earners and beneficiaries don't get enough of an increase to cover higher costs, and mid to high-income people get more than their actual cost increases, mortgage interest rates aside, but at least that's an asset owned. What do you reckon, Susan?
Yeah, so I talked to Gareth Kiernan, who's chief forecaster at Infometrics, about this. I had a feeling that it's because it's a bit unwieldy to talk about the dollar increases that people are getting. He says average hourly wages rose by $1.87 over the last year, or $1.86 per hour if overtime is included. Or he says also that average weekly earnings rose $66.40 over the last year. So that data comes from the quarterly employment survey. But he pointed out that without the percentages and the context of things like the rise in inflation over the year, the figures kind of don't really mean very much. He says one of the problems is that it's much more difficult to say how much people's spending increased in dollar terms or would have increased if they kept buying the same basket of goods and services that they were a year ago. And it's much easier to compare by looking at percentage increases in incomes and percentage increases in costs and being able to make the inference that people have a greater or a smaller proportion of their income left over, depending on which one rose fastest. He says Rosie's also probably assuming that everyone's costs increase by the same dollar amount. So people who are getting a smaller dollar terms increase aren't getting enough to cover their costs. He says he can understand the implication that low-income people have less discretionary spending that they can cut back on if necessary, compared to high-income people, which is why low-income people are typically understood as being hardest hit by large or unexpected price rises in essentials like food and electricity, which we've seen a lot lately. But then if we want to make a fair comparison, he says we need to start asking even more complicated questions about the value of their spending and what's necessary, what's discretionary, and then trying to measure it. So it's all just really complicated, basically. And he points out that no, the percentage increases don't actually increase income inequality. If everyone's pay went up 4%, for example, there's no increase in that. But if we think that the 4% increase is just enough for the poorest people to get by, but the richest can then save more, there will be an increase in wealth inequality, but not income inequality. He says a bigger problem that we rely so much on averages, which goes back to that question we had last week about whether we should look at the median or the mode. And he says we don't have as much information about the differences across the different income bands.
That was a long answer.
That was, I'm sorry. Hopefully it was useful.
Going to go on to our next question here from Miriana in Whangarei.
Susan, what's happening with interest rates? And if I'm a homeowner, what should I be thinking about right now?
So people often ask what home loan term they should fix for and what they should think about when they're deciding which interest rate to take. And it's really hard because you only really know what's going to happen with home loans in retrospect. When rates went below 5% a few months ago, I thought that was pretty good, but they've continued to drop further. So in retrospect, I shouldn't have fixed some of ours for 4.99, but it is what it is. Now we've got the Reserve Bank cutting the official cash rate again and markets pricing in more falls. I talked to a couple of experts about this. First, I asked Gareth Kiernan again whether he thinks rates are about as low as they will go now overall.
Well, I noticed the one-year rates have already moved down for most of the main banks last week or so. Wholesale rates probably will fall a bit further because the full chance of a 50-point cut isn't priced in. So there's some potential there, but I think a reasonable amount of movement has already happened.
He says there's probably a little bit further some rates could fall, but if you can fix at about 4.5% now, you're probably not going to regret it too much. Then I asked Kelly Eckold, who's the chief economist at Westpac, whether he thinks it's worth fixing for longer now.
Yes. I guess, we're a little bit cautious about the recovery in terms of, we've been talking about sort of provincial-led recovery and, good export prices and that sort of thing. And we're only slightly nervous, but it's just sort of watching, wheat meat volumes, a bit of softness in dairy and horticulture prices coming through. So, does that mean that sort of recovery next year is not quite as strong as we might have anticipated previously? Having said that, we're also nervous that the Reserve Banks could well be overdoing it now, and then be needing to raise rates by late 2026. So there's take all of that together. I think it is evidence suggests we are close to the bottom, but there is still a heck of a lot of uncertainty out there.
I personally think if you are due to refix and there's a rate that you're comfortable with, particularly if it lets you pay off your home loan a bit faster, just lock it in and then try to forget about it, because there are better things to spend your time thinking about, I think. The best thing you can do is try to pay off more than the minimum repayment, because over the long term, that can make a much bigger difference than whether you fix it 4.69% or 4.39% or 4.99% like I did.
Pay off more than the minimum repayment makes a big difference. How big a difference are we talking about here?
Yeah, a big one. I did this exercise recently and worked it out. Well, tried to. Okay, so assume you have a mortgage that's $500,000 and it has a 30-year term. If you were previously paying 7% on that loan, you'd have been paying $768 a week. If you refixed now at 4.7%, if you kept your repayment at that $768 a week level, you'd repay your loan 11 years earlier and you'd save more than $400,000 in interest. And even if you didn't have such a big change in interest rate, if you went from 5.5% to 4.7%, if you kept your repayments the same, you'd pay off your loan 5 years early and save about $180,000. So even just a small extra payment does make a really big difference, because it just goes on and on over time.
Moving on. Another question that's been popping up online a lot lately, and in our discussions too, is why people can't withdraw their KiwiSaver money just whenever they want it.
Yes, there's definitely a sense out there from some people that, it's my money. Why can't I just close my account and get it? I also see this in questions from people who want to use it to pay off their mortgage and that sort of thing. And the answer is that the scheme is designed to provide for your retirement. And that's why there are incentives from employers and the government, although I know the government contribution has significantly diminished over the years. The trade-off is that you're meant to be agreeing to leave that money there until you're 65 or you buy a first home. So you can't just close it and get your money out unless you're moving permanently to a country that's not Australia. On a side note, I did have a question come in about the impact of the government's reduced member tax credit on a typical KiwiSaver balance. That's halved from $521 a year to about $260. It was initially $1,042 when the scheme began. So Rupert Carlyon, who's the founder of Kora KiwiSaver, worked out that someone earning $80,000 a year, contributing 3%, starting at the age of 30, they would have a balance of $594,000 by the age of 65 under the old government contribution, which is that 521. With the reduced amount, it would fall to 572,000. So it's not a huge difference, but it does make a difference. He says the big question, and this isn't actually something I'd thought about, the big question is whether the $180,000 threshold at which you stop getting that contribution will be indexed, or whether it will move as general salaries increase, because otherwise lots of people will find that their pay will take them up the scale and eventually they'll just stop getting it.
And we've got one more question today from Yvonne. My question is about the high phone and internet bills that our house has. Now, a lot is made of the high amount that we all pay for power, and that's true, Susan, you and I have talked about that quite a lot. But in our household, I find our phone and internet bill with Spark are very high, and I'm not sure how it's justified. I haven't questioned it with Spark, and I believe our costs are pretty standard. But what are the costs these companies have in providing phone and internet to their customers? Are the lines all in place? What's going on? What costs do they have to justify these high bills? Susan, go.
Yeah, so I went to talk to Spark about this and they haven't got back to me in time. So I also talked to Paul Brislin, who's the Chief Executive of the Telecommunications Forum. He says the Commerce Commission says that telcos make about a 4% profit, so they're not making stacks of cash. He says it's one of the few areas that hasn't increased dramatically in price over the past decade, while other utilities have soared. Stats NZ says prices are up by 7.4% since January 2018, while electricity is up 17.8%, gas is up by 44%, and local rates are up by 61%. So it definitely is lagging on those measures. But I think if you are paying bills that seem really high, it's worth shopping around to see what else is out there. There are comparison sites and things like that that you can use to make sure that you're getting the best deal that you can.
And if we can, we'll see if we can get a response from Spark for the next program.
Yeah, that's right. If I hear anything, I'll definitely follow up.
Cool. All right, and to wrap up this episode, Susan, you've been looking into child support issues this week. Why?
Yes, it is a minefield. I was contacted by a mother who was really struggling with what she was asked to pay, and then I spoke to some other people, a divorce coach, people like that, who had some concerns about how the whole child support system works. And I think it's one of those issues where it's really hard to keep everyone happy. I heard from a lot of parents who receive child support who say they don't get enough. And then I heard from a lot of paying parents who feel they have to pay too much. The woman I spoke to says she's earning $87,000 a year but has to pay $300 a week in child support, and she can't afford to even rent her own place anymore. So it is a really complicated thing, I think.
It does sound complicated. And how was that complicated equation arrived at? Basically, how is child support calculated?
Yes, complicated. When parents don't have a private support agreement in place, child support is worked out based on the child's age, the parents' incomes, both of them, and their living situations, the amount of time a child has in each person's care, the cost of bringing up a child, and the cost of any other children that the parent might have. So each parent is then given a living allowance that's updated each year, and an allowance for children not having child support paid for them, so the other children in your house, basically. And Inland Revenue's calculator shows that for this tax year, someone earning $120,000 a year with a child in her care 6 nights a week and an ex-partner earning $150,000 with the child the other night could receive about $14,374 a year in child support.
Okay, but what are the main issues here?
Well, I think there are lots of concerns about transparency. I mean, having to do this sort of stuff with your ex-partner can't be easy, but people often seem to think that both paying and receiving parents are hiding income to either increase or reduce the amount that is paid. If someone has more kids, it can reduce the amount they're supposed to pay for the existing ones, that sort of thing.
As you say, complicated. But what can people do if they're not happy about the arrangement that they've arrived at?
You can contest an assessment, but in some cases people have to go to court, which does seem to be an expensive exercise.
Every time.
Every time, yeah.
So that's it for this week.
Thank you for all your questions. As always, send them to us at questions@rnz.co.nz. We can take them by email or voice memo.
And audience question time. Last week we asked you when New Zealand first introduced its own currency.
You might have thought of the New Zealand dollar, which has only been around since 1967, but the New Zealand pound was introduced before that in 1933. So that's your answer.
I thought it was 67, but there you go. Stupid questions, that's my job. And now, our question for this week is, when do you think we're going to see King Charles in our banknotes and coins?
Send your answers to questions@rnz.co.nz. Bye for now.
No Stupid Questions with Susan Edmunds was written and presented by Susan Edmunds. Justin Gregory is the producer, the engineer is Steve Burridge. Thanks to Rosie, Yvonne and Mediana, that's me for the questions, and Gareth Kennan, Kelly Eckold and Paul Brislin for the answers. Follow and listen to No Stupid Questions with Susan Edmunds on Apple Podcasts, Spotify or any podcast app so you don't miss an episode.